From a billionaire genius to the center of one of the largest financial scandals in history, Sam Bankman-Fried's rise and fall is a story of ambition, innovation, greed, and shocking betrayal. Once hailed as the wonder boy of cryptocurrency, Sam Bankman-Fried's name used to send ripples through the financial world. At just 28, he had already accumulated billions and transformed himself from a quiet, math-obsessed MIT graduate into the bigwig of a digital empire. Born in the heart of Silicon Valley, Sam was the child of two Stanford law school professors, Joseph Bankman and Barbara Fried. His household was a hub of high achievement. Since childhood, he was surrounded by deep discussions on law, economics, and ethics. As a young child, Sam displayed exceptional aptitude for mathematics. He was known to solve complex equations. He often chose to spend his free time engaged in intellectual challenges rather than typical childhood activities. After a stint at a high-frequency trading firm, Sam took a leap of faith into the extremely volatile world of cryptocurrency by launching Alameda Research, a quantitative trading firm focused on digital assets, in 2017, and then FTX in 2019. FTX was a crypto exchange, a platform where people could buy and sell digital assets like Bitcoin, Dogecoin, and Ether. He established Alameda Research in Berkeley, California, where he was grown up. In 2019, Sam relocated the companies to Hong Kong, due to a comparatively friendlier regulatory environment. He moved there with a small band of traders, including Caroline Ellison, with whom Sam was romantically involved at times. Celebrity endorsements and major sports sponsorships made FTX hard to miss, and soon the exchange became the crown jewel of the crypto industry, boasting millions of users and daily transactions worth billions. The aggressive marketing campaigns promised that people could earn higher yields than the average bank return.
You just need FTX!
It's FTX. It's a safe and easy way to get into crypto.
The exchange quickly rose to dominate through high-profile acquisitions of struggling competitors, such as Liquid Global, LedgerX, and Blockfolio. But behind all this spectacular rise, a storm was brewing. What the world didn't see, or perhaps chose to ignore, were the cracks forming beneath the surface. FTX was more than just an exchange. It was a house of cards built on leverage, risk, and a labyrinth of financial maneuvers that eventually came crashing down. Today's video is brought to you by Prime Emporio, your one-stop destination for various household and fashion products and accessories. Discover the ultimate shopping experience at their online store, offering an extensive range of products. Don't forget to check out their online store and treat yourself to something special. FTX was supposed to keep its customers' money safe like a bank does. But instead, FTX secretly used its customers' money for risky investments and personal projects. Money that belonged to customers was used for gambling in ways that no one knew about. Crypto market began to boom in 2021. And the price of Bitcoin, which had traded at around $10,000, shot up, peaking at more than $64,000. Money flooded into crypto, and crypto platforms moved to attract customers. The price of Bitcoin, which is generally seen as an indicator of the broader crypto market, declined dramatically from its late 2021 heights. Other crypto and token values followed the suit. The broader crypto industry decline forced many major platforms to shut down, but FTX seemed immune, even buying up some of its struggling competitors. When Hong Kong became too hot to run an apparent international cryptocurrency casino, Sam moved to Albany, Bahamas with his few top executives, where he lived in a $30 million penthouse in the compound's seaside orchid residence. From there, he and his 9 confidants ran a Bernie Madoff-like empire, living a pampered life where employees ordered toenail clippers on demand. The group lived a high-end, secluded lifestyle despite Sam's public image as a frugal, hoodie-wearing tech mogul. Albany is not a typical tropical paradise. The 600-acre property, located on the Bahamian island of New Providence, attracted the likes of Tiger Woods and Justin Timberlake for its grand opening in 2010, and homes sell for tens of millions of dollars. There is an 18-hole golf course designed by Ernie Els, a 71-slip mega yacht marina, and 11 closed-to-the-public restaurants. Wealthy residents can gaze at a perfect replica of Arturo Di Modica's Charging Bull statue, and send their children to a boarding and day school spread across 2 campuses. Albany is the type of place where, if you show up to its front entrance in a taxi and ask if you can come in, the guard replies with a smirk and tells your driver, you should know better. It's the type of place where if you station yourself a bit down the road to take some pictures of the sign, an unmarked car shows up within minutes to ask what you're doing. Things began to change for Sam in November 2022, when the balance sheet of Alameda Research was published by CoinDesk, a crypto-focused digital media website. It showed that Alameda held a large amount of a digital currency created by FTX. That digital currency was FTT, which held a certain market value, but if the price were to drop, Alameda would be at risk of insolvency. The balance sheet leak sent jitters to the market. A rival platform Binance's CEO, Changpeng Zhao, who was the investor of FTX in its early days, announced on November 6th that his company would sell off all its FTT tokens. Consequently, the price of FTT dropped sharply. As the price dropped, many FTX customers moved to withdraw their assets from the platform. The withdrawals ended up resembling a classic bank run, in which people worried about a bank's solvency rush to get their money out before it runs out of cash. Billions poured out of the platform in the blink of an eye. On November 8th, FTX stopped allowing customers to take money out of the platform. What was still not public was the extent of the connections between Alameda and FTX, and how bad things had gotten for Sam's companies. The connections began to become clearer in the days following FTX's move to stop withdrawals. Media organizations such as Bloomberg, the Financial Times, the Wall Street Journal, cited anonymous sources saying that FTX needed $8 billion to cover the gap between what it owed and what it could pay out. In an old-fashioned embezzlement, FTX was actually taking money from customers and using it for its own purposes. Around $11.3 billion in customer funds were supposed to be held at Alameda by FTX, but only $2.3 billion could be located. The rest had gone towards political contributions, charity foundations, and real estate purchases. FTX, remarkably, had left almost no records of transactions.
One of the reasons FTX went bankrupt is because FTX deposits were used to pay Alameda's creditors. Carolyn Ellison said you knew about that. Is that true?
You know, best I can tell, Alameda did have a big position open on FTX. That position, I think, was very over collateralized a year ago. There was a total market collapse, and specifically a large correlated collapse in its assets over the last month, and to some extent over the last year, that threatened that position quite a bit. And I think that's as best I understand, a lot of what happened there.
I am no cryptocurrency expert, I'm no finance expert, but I don't think you answered my question. I was asking, did you know that FTX deposits were used to pay off Alameda creditors?
I don't know of FTX deposits being used to pay off Alameda creditors.
The harm was vast. The remorse was non-existent. Effective altruism, as lived by Sam, was a lie. FTX collapsed over 10 days in November 2022, and soon after filed for bankruptcy. The empire, which was once compared to titans of finance, like John Pierpont Morgan and Warren Buffett, collapsed. The once cherished cryptocurrency king went from industry leader to industry villain, lost most of his fortune, and became the target of investigations by the Securities and Exchange Commission and the Justice Department.
I can't imagine what it feels like to go from $20 billion to $100,000.
Yeah, it's been a really humbling fall in a lot of ways.